Hello, friends. My name is Chris Lee, CPA, and I am, an accountant and a tax strategist that works with growth-minded entrepreneurs to help them achieve smarter, tax-efficient growth. And so, just want to talk about kind of a common thing that I see, kind of as people think about their taxes and tax planning. And most of the time, this comes down to entrepreneurs knowing they've got to, implement, pursue some sort of tax planning, tax strategy along the way, but they spend so much time researching all of these items, not fully understanding, how it might apply to them. And most of the time, this comes down to the fact they lack a framework for how to think through these items. And when I think about tax planning and the way I teach my clients to think about tax planning is that everything boils down to two primary functions that we're using different strategies for, and that is to manage the timing of income and deductions and to manage the character of income and deductions. So when we think about all of these items, we want to think in these two camps and or think of them even as levers. So when we're working on, a tax plan and that sort of thing, is what lever are we using the strategy to pull? And do we have a need to pull both levers, a timing lever and a character lever at the same time in implementing someone's tax plan? And so not all strategies apply in such that we can, do both things at the same time to overall, reduce taxes in a given year, or even better, reduce lifetime taxes. That's really what the most effective tax planning is going to be doing, is we look at, your lifetime tax bill, not just any single tax year. And so that's where sometimes we make choices based on those outcomes. And so again, the two levers we want to think about are the timing of income and deductions, and that is to say, what tax year will they land in, and also the character. And the character question really gets at what rate am I going to be taxed based on this, item of income, item of deduction, or to think about what other limitations might apply in the case of there being losses or deductions and that sort of thing. So is there going to be a rate effect based on the character of that income or deduction, or is there going to be some sort of limitation based on that character of income and deduction? And so when it comes down to the timing, we just think about the fact that the IRS taxes you on a calendar year basis. And so what we do with timing strategies is we choose to shift income and deductions across tax years. Fundamentally, what we want to do is have income taxed at the lowest rate possible, and we want deductions to be taken at the highest rate possible. That is to say, when an item is actually going to actively be taxed, we want it to be taxed at the lowest rate. And so that's why we put as much income as we reasonably can into a year where it's lower tax rates without, shifting our tax rates up in maybe a different bracket. Or we look at getting deductions pushed into a tax year where we, larger deductions pushed into a tax year where we have a higher effective tax rate. And so this comes down into thinking about acceleration strategies or deferral strategies. So all within this timing bucket. So when we think about accelerating income, we might do this by considering invoicing clients quicker. So if we invoice them quicker, usually they'll pay quicker. Depending on your business, you might have collections issues, but that's fundamentally what we're thinking about there. We might choose to accelerate negotiations in contracts to get a deal done sooner rather than later to ultimately impact that cash flow. So maybe one-off transactions or more infrequent style of transactions, we might, actively be choosing get this transaction done or get this deal closed so that we can, accelerate the cash component of it. Or this might even be as simple as selling appreciated stock in a year where you might have a low tax bracket. And so it's unusual to hear someone say, trigger a gain on your stock portfolio. But sometimes you might be doing that at a 0% tax rate if you're doing this right. And so the consequence being that you get gains taxed at a 0%. And then maybe down the road, when you make a transaction to liquidate or ultimately sell those transactions in a way that you're cashing out of the position, you've got very limited gains, right? Or, ultimately zero in the higher tax year, because we're doing some strategies to shift and ultimately increase our basis in a transaction. So that's on the acceleration of income side. When we accelerate deductions, we usually are thinking, bonus depreciation. That's everyone's favorite word in the real estate space, is talking about bonus depreciation, 168K. Good strategy, but it's not always the best. We also have Section 179 expensing for, vehicles, equipment, other sorts of items. I personally like planning around Section 179 better than bonus depreciation, because with Section 179, you can actually choose specifically what assets you want to expense in a given year and make a choice on it, whereas bonus depreciation applies to all assets that get purchased that have a given life based on the tax code. So the tax code says how long different assets are supposed to be on the books for. And so bonus depreciation takes all of your assets and drops them into life classes, asset classes, and then it says everything in that bucket has to be, elected on bonus depreciation or elected out of. So you basically have these big pool of assets that it's all of them get expensed or none of them get expensed. In Section 179, that's not the case. So we get a little bit more flexibility when we are working through those items. And so another option for accelerating deductions would be, making charitable deductions sooner rather than after year end. So if you're going to make a charitable donation at the start of the next year, you might consider going ahead and doing that on the before year end to get that accelerated in. And sometimes when we're thinking about charitable deductions too, we can also think about, if we don't know necessarily what charitable organization we're going to give to yet, we can contribute to, say, maybe a donor advised fund, which lets you, put it into a qualified account that gets you that charitable deduction when it's paid into the account. And then ultimately you can distribute those funds from your donor advised fund to your preferred charitable organization. So those are, the acceleration some common acceleration strategies on the income side and the deduction side. And then we also can think about deferral strategies. And deferral just means, rather than recognize it now, we push it into a future tax year. So when we think about deferring income, this can be delaying invoicing. So the opposite of, invoicing earlier, it can actually be invoicing later. And so something that we could consider doing, in the last month of the year is, rather than billing earlier, we bill later to manage those tax consequences. We can also, if we're doing a large sale of a business or some particular asset, or maybe even a business unit, we could use an installment sale method, which is, rather than recognizing the gain all at once, as proceeds are received, we're gonna, recognize the consequential gain from a transaction over multiple tax periods that those cash flows are received. And then another option we might use is structuring escrow funds in certain taxable transactions, so that because most often funds that are contributed to an escrow account don't become taxable to the taxpayer until the taxpayer takes possession or has conveyed those funds. And so depending on what we're doing and what sort of transaction, windfall event or whatever, we might think about using escrow accounts in a specific way to manage our tax consequences. So those are the deferring income strategies. On the personal side, you can think of them as, you could also use retirement account planning, using traditional 401ks and IRAs to achieve very similar consequences. We don't recognize the income now, we're going to defer it and recognize it in retirement by using a tax advantaged account. Then we might also consider, deferring, so waiting to claim deductions. Rather than accelerating depreciation, we wait and use the actual depreciation life that the IRS gives us for a specific asset. So that's one item we might do. Rather than, another item when it comes to depreciation is, rather than choosing to elect to, expense over the full life, we might choose to defer that equipment purchase until the next year, right? And that, after the year end, we'll then buy the piece of equipment, the larger piece of equipment, and consider then using some accelerated depreciation methods to get all of that expense in a later year rather than an earlier year. So just choosing to make that purchase at a different time can help us also with that sort of planning. Charitable giving, you can also, rather than taking it earlier, take it later, and choose to put those gifts into a higher tax year where it's going to benefit you the most. So yeah, those are a couple of strategies we would often think of in the timing space. Now, when it comes to character, this is a little bit more complicated, and it really takes usually like a multi-year plan. But overall, when we think about character, we want to think about the tax rate that's going to apply to this income. So there are some key buckets to think about, and that's going to be whether something is ordinary income, or if it's going to be long-term capital gain income, or if it's even going to be considered earned income, which is going to have some self-employment taxes of 15.3% layered onto the ordinary income tax rates. And then we've got some other kind of tangential buckets that we think through, is whether or not it's going to be qualified business income, whether it's going to be passive income, active income, or portfolio income. So kind of all these things end up working together to get to an overall tax consequence. The primary things we're usually managing is, is something going to be taxed at the unfavorable ordinary income rates or the favorable long-term capital gain rates? That's usually what we're thinking about. And then we're also looking to manage passive activity consequences. A few strategies that we'll use in shifting the character of income might look at, using an S corporation and a reasonable salary to manage the consequences of that 15.3% self-employment tax. And so we'll use that strategy along the way, sometimes if it makes sense. Another strategy that gets much more advanced is if you function in a partnership, an entity that functions as a partnership for income tax purposes, and you're buying out another partner, we might use what's called a Section 754 step up, which lets us take what would usually be a capital gain transaction, or rather capital gain deductions, and transform them into ordinary deductions for that remaining partner in the partnership. So this is a favorite strategy that is pretty complicated to implement. You definitely can't do it on your own, but it is a very meaningful one. Another one, my favorite, qualified small business stock planning, QSBS. Sometimes you'll hear it referred to as 1202. This basically lets us get, the sale of a business taxed at 0% for federal income tax purposes if we do all the right planning. When we do QSBS planning, it's a minimum of a 3-year planning window, and most often it's like 5 years. So when we do all of these strategy sessions and sorts of things, we have to think about the long game, not only the short game. And so that's kind of one of the more important things. So those are some of the primary strategies we'll see with managing character. These are much more complicated because you have to have a pretty thorough understanding of tax law to get these in the right strategy, to get the consequences you want and to actually implement them properly. It's not just putting money in the right place, it's making all the right elections along the way, which are much more convoluted and complicated to execute by yourself, but it is definitely something you can learn about. So with those two camps in mind, right, like we've got the timing of income and deductions and characters of income and deduction. When we think about those items going forward, you will be more attuned to understanding what you're reading as it comes to tax strategies. And finally, the most important thing to remember when it comes to tax planning is we never make a decision purely for tax reasons. Most of the time, we have to look at our whole economic context that is going to apply to us to determine what is the right outcome that we're going to get, or the right outcome that we can get with the most tax optimized position. Because honestly, sometimes if you're looking at some sort of deferral strategy and that sort of thing, you might lose out on an opportunity, to be honest, like just because of the economic lag. And it gives, customers an opportunity to buy from another provider, or it gives an opportunity for maybe a transaction to evaporate entirely. They've just chosen not to have a buying decision. You're looking at, macroeconomic trends. And, if you wait to do something for 3 months, the economy could collapse. And what is the consequence there? That the deal never happened at all. So we always have to look at the broader context and not just the tax consequences. And so this is the most important thing that it's my job to remind people of, is not everything based on tax. And that's coming, from a 10-year plus seasoned tax pro with a master's in tax. And so I fully help my clients understand their context so they're making choices and, help guide them in the right direction. So with that, I encourage you, if you think we might be a good fit to work together, if you'd want to work together directly, go ahead and go to my website, cleecpa.com, and go ahead and book a quick intro call, and we can, see if we'd be a good fit and consider, working together on the other side. So with that, you'll have a video, another video in the near future. So until then, talk to you soon. See you, friends.